Reinhardt and Rogoff, their research has shown that as soon as a country passes 100% debt to GDP, you pass the critical threshold,
Mhm.
and it's very hard to get back from that. We're
Mhm.
past 100% debt to GDP, which depends on which data you look at. We're anywhere between 120 to 140% debt to GDP on balance sheet.
Mhm.
If you look at off balance sheet debts, we're almost at 300%. So we passed the threshold and we're just continuing at about, you know, roughly 6, 7, 8% a year. So we got to prepare for it.
Hi, Adam Gower here, founder of GowerCrowd.com and host of this show, Real Estate Market Watch, current events through a real estate lens. My guest today is Paul Daneshrad, founder and CEO of StarPoint Properties, one of the brightest guys in the commercial real estate industry. And of course, I have to say that because he sees the world exactly the same way as I do, right? So you're going to hear from Paul about his book, Money and Morons. And we're going to dive into, he talks about the great conflux, and we're going to talk about what it is that is converging at the moment, what to be watching for, and how to protect yourself during these uncertain times and going forwards, in fact, over the next few months and years. If you've not been to GowerCrowd.com and subscribe to my newsletter, please do that. I will provide a summary of this conversation and of other conversations in this series there at GowerCrowd.com on the newsletter. You can always unsubscribe, but it's all there at GowerCrowd.com. All right, let's just jump straight into my conversation with Paul Daneshrad, founder and CEO, StarPoint Properties. Here he is. Paul, fabulous to see you again. Thanks so much for joining me on the podcast. So, January 2024, you wrote a book or published a book, Money and Morons, in which you talk about the great conflux. Obviously, that was a whole age ago. But what exactly is converging, and why should real estate professionals and investors care right now?
Yeah, I mean, so so the book really talks about, at its essence, that we have a national debt problem, and the debt problem has become structural in nature, so we're not going to really solve it. And when you look at sort of some of the leading thinkers around this issue, Reinhardt and Rogoff, two economists who wrote a book called This Time is Different. Um, and you look at their conclusions and their historical analysis around national debt or sovereign debt and what happens when you pass certain thresholds,
Right.
you realize that one, the US has passed those thresholds, and two, we're not going to be able to really solve the problem in a simple way. And since there's no simple solution, the most likely result's going to be that we're going to end up in crisis. So if you're in real estate and you're a real estate investor, operator, almost any facet of real estate, you got to prepare for it because the national debt, as we all know. Actually, have you heard? I love this quote. I just learned it. I saw it the other day from Charlie Munger, and he said, "Be be aware or be fearful of the three L's in life." And he said the three L's in life that will get you into trouble. Is what two of them are liquor and leverage. Um, And the leverage part of his comment was basically that, whether you're an individual or you're a corporation or you're a sovereign nation, too much leverage is going to, can kill you. And that's the path.
Well,
Go ahead.
yeah, well, what's the third L?
Ladies.
I was going to say licentiousness. That's exactly.
Yeah, yeah. I didn't know if that was I didn't know that was appropriate for the podcast, so I left
It's
that
all right.
twist
It's not for children, this program. We're good. Okay, so what are the, okay, so you wrote this and published it in a little over about 18 months ago. The world has changed dramatically. We have a new administration trying to handle some of these issues. What's going on in the world today in the context of this debt crisis that we're in, and in the sense of it's a crisis becoming increasingly imminent, if at all?
Yeah, yeah. Yeah, it's an interesting paradox because arguably you could have said that years ago this was a partisan issue, right? The Democrats were supposedly the spenders, the Republicans were the debt hawks, Republicans were smaller government, Democrats believed in bigger government and more subsidies. That's changed a lot. If you actually look at the hard data, both the Republicans and Democrats now run annual deficits and keep adding on to the debt. And if we look at this current administration, right? So you sort of said, yeah, we're in a new world, we have a new administration. Right? Mm. And so much of it, it's just rhetoric, right? So we have Doge. Doge is, actually, I don't know what Doge is.
I was going to say, yes, exactly.
They say Doge is an attempt to cut costs. Mm-hmm. But that same administration that has introduced Doge to cut costs is trying to pass through and is going to pass through a budget that is going to have annual deficits of about $2 to $3 trillion. Mm. And if this budget stays in place for an extended period of time, is going to add $20 trillion to the deficit over 10 years. Interesting enough, if you saw the headlines this morning, Musk, who was supposedly, part of Doge, if not the head of Doge, right, and, has got arrows in his back and has ruined his reputation and has taken enormous amounts of sort of, a beating over this, said that, Doge is useless when the government or the administration is trying to pass through a budget that's got annual deficits of $2 to $3 trillion. So we have a Republican administration who is not worried about the debts or deficits, despite what they may say.
So what is the implications of this? And help me work through it. So we've got this huge deficit. It's going to get bigger. And there are macro economic factors that are going to affect the economy. The dollar, exorbitant privilege, treasuries, interest rates, etc. Kind of help me understand what this mosaic looks like and why it's bad and what is the direct effect of this on real estate, and then we'll get to how you insulate against that.
We're likely to have a debt crisis. When that happens, I mean, no one should try to guess. We've got a little bit of runway. The reason we have a little bit of runway is because we are the world's reserve currency. We are the largest economy in the world. We do control our own currency and we can print, and there's still enough confidence in our debt where we're paying a reasonable interest rate. Mm-hmm. So it's hard to predict when there's going to be a loss of confidence, and that will end up leading to a debt crisis.
Okay.
And so when that happens, we're likely to see, hyperinflation and hyper interest rates. When that loss of confidence happens, no one's going to want to buy our bonds at 4%. They're going to expect us, pay for the risk. They're going to expect a higher premium. I don't know what those rates would be, but if you're in a business that is interest rate sensitive, which real estate is highly interest rate sensitive. You got to protect against that. There's a bunch of ways to do that, but that's a likely scenario. Reinhardt and Rogoff, who are, again, some of the leading thinkers, you're talking about a Harvard economist, you're talking about, two people who have been in world economics for decades, both, professionally, intellectually, and academically. They are the leading thinkers here on this topic.
Mm-hmm.
And, their research has shown that as soon as a country passes 100% debt to GDP, you've passed the critical threshold, and it's very hard to get back from that. We're past 100% debt to GDP, which depends on which data you look at. We're anywhere between 120 to 140% debt to GDP on balance sheet. If you look at off balance sheet debts, we're almost at 300%. So we've passed the threshold that the leading thinkers on this topic have, said was critical, and we're just continuing at about, roughly 6, 7, 8% a year. So we got to prepare for it.
Well, so how do we prepare? All right. So we're talking about. So in your book, I read from cover to cover. I really enjoyed it. But the one thing that I was looking for was real estate strategy. All right. So what is the approach if there is this possibility of hyperinflation, hyper interest rates, a debt crisis, a loss of confidence in the faith and credit of the United States government, and we do see a crisis. How do we insulate ourselves? What are you doing in terms of your real estate investing to insulate against that possibility, not knowing when it's going to happen?
Yeah. So there's no adjustable rate financing anymore, unless you have a really short business plan, meaning 1 or 2 years. Any assets that are generational or have a longer term business plan, 5 years plus, 10 years plus, all need long-term fixed financing. And I don't know if 10 years is even enough, right? I mean, it's really hard to predict when the crisis is going to come. So even if you get 10 years fixed financing today, and the crisis happens 8 years from now, and you only have 2 years left, you're going to be sort of in a tough spot. And so, we've transitioned our portfolio, 20% of it already, to fixed financing that's 20 years or greater. It's hard, it's more expensive, but it's a defensive position. So if you believe in my thesis, and by the way, it's not even my thesis. I think what was really important here, Adam, which I mentioned in the book, but I don't think I said it clearly enough or with enough emphasis. This is not me saying these things, right? We have some of the smartest thinkers on the planet, right? I don't know if you saw, the head of JP Morgan, Jamie Dimon, what he said a couple of months ago, which he said, listen, our debt is serious. It's going to lead us to crisis. Even Jerome Powell, right, the head of the Fed, he has a dual mandate. His job is only 2 things, right? Keeping us employed, right? Full employment, as they call it, and controlling inflation. That's their dual mandate, right? Jobs and inflation. He is not supposed to worry about the debt or the deficits. It's not within his purview. It's not within his dual mandate. And actually him even talking about it is really sort of outside the norms of, his political spectrum. He came out 3 months ago and said, this deficit and debt is such a big problem that if we don't solve it and have an adult conversation about it, it's going to hurt the country. Right? And he took some serious risk in saying that because it's not within his realm of responsibility. But he's so worried about it that he felt like he had to say something. And I can keep going on and on about the people who have, some of the smartest people, even Ray Dalio, right? Ray Dalio runs one of the largest, again, for those who know Ray Dalio, I don't need to explain who he is. Even he came out and said, look, we have a debt crisis coming and we're not solving the problem. So there's a lot of really, really intelligent people and smart people in the right spots warning us about this, and we're just ignoring it. And so, taking a defensive measure and protecting yourself, especially in real estate, it's not going to be easy. There's going to be a cost to it. Putting on, 15-year, 20-year, 30-year fixed financing is not going to feel good, right? But if you believe in the thesis and what smarter people than me are warning us, then, there's a cost to that insurance. And so what I would tell everybody is I'd start fixing your portfolios that have long-term business plans to 20 or 30-year fixed financing.
Okay, so I love that. I mean, it's just...
You love the topic of the doom, gloom, and crisis?
I am super doom, gloom, but I also like the idea of discussing how to prepare for that.
Yes.
Right. And in fact, one of the questions I was going to ask you, but I'll move on to another, but how many people in your world see the world in the way that you do and are thinking about 30-year debt? Right. So what's going on? What are to coin your phrase, what are the morons doing these days?
Yeah.
In real estate, right? The real estate.
I wouldn't call the morons real estate. My title of my book, Money and Morons, the morons was really just referring to the voting public and how, 86% of the country says they're worried about our debt or deficits, right? That same 86% that are saying that they're worried about our debts or deficits will not vote for a politician that's going to solve the problem.
Right.
That's moronic to me. If you're worried about the problem, then vote for politicians that will solve it. The reason they're not is because there's pain involved now. The problem is so big, there's no simple solutions. It's going to require pain to solve it. And the average voter or the populace don't want any pain. They want easy solutions. They don't exist anymore. So that's my reference to morons in the title of the book. Yeah. Back to your question. No, I'd say most of my peers, colleagues who agree that this is a real issue, they're not putting on 30-year debt because it's painful. It's more expensive. It's hard to get. It impacts their cash flows. And like everyone else in the world, that same 86% that's worried about our debts and deficits, but won't vote for a politician who will solve it. And, my peers who, don't want to put on 30-year debt because there's pain involved, they all shift to what I call normalcy bias.
Yes.
And normalcy bias is an actual psychological term, which means that I need to be normal right now. I just want to feel normal. I don't want to worry about all these problems that I can't solve and that are out in the future. I just want to forget about them and I just want to be normal. I just want to feel normal. That's the normalcy bias. So we all sort of revert to normalcy bias because, we can't solve the problem. We don't want to worry about it.
So what about other strategies? You talk about long-term debt. Okay. So I buy that. 30 years, you sleep at night, you can project more accurately. What other strategies are you implementing today? For example, level of debt.
Yeah, so we're deleveraging. So we were, as an institution, we had a standard levered rate in the portfolio of 70%. We're getting that down to 40. So we're going to go from 70% down to 40 gradually. That's going to take time. So again, at our peak, we were 70. Today, we are at about 54. So we're halfway there to our 40% target. And we are also putting in certain other hedges. So we're diversifying a little further outside the United States for the first time. That's challenging. But I'd also, we're also diversifying outside of real estate. Real estate historically has been a great inflation hedge, but in the debt crisis, that could get really, really complicated. And so having some diversity outside of real estate also sort of makes some sense to us. And so we are executing on that too.
How does real estate become more complicated in a debt crisis?
So when interest rates rise from 6% to 15%, you got a real estate crisis. You have a loss of value of just trillions.
And doesn't that speak to opportunity, though, for guys like you who are delevering, taking on long-term debt? It speak to opportunity. Like, what kinds of asset classes are you looking at?
Asset classes as it relates to a future crisis, we're not. We're not that smart, and it's too hard to forecast when the crisis will happen. I still hold out hope that it won't. I still hold out hope that, this is a populist issue. This is not a political issue. I have this debate and argument regularly. The average person loves to just have this default and say, oh my God, our politicians are idiots, right? They're not solving this problem. Well, that's just not the case. This is a populist issue. You want to solve the problem? Vote for politicians who have a mandate and a political platform that says, okay, we're going to solve this problem. And that we accept that solving this problem is going to come with pain.
Right.
Right? But we're not doing that, right? We continue to vote for politicians that keep promising us all these things that we can't afford. Right? Lower taxes, more entitlements, maintain Social Security, maintain Medicare. The Social Security and Medicare trust, the trustees for Social Security and Medicare, nonpartisan, they're not Democrat, they're not independent, they're not Republicans. These are the trustees of Social Security and Medicare, say that the programs are going to be bankrupt within 10 years. Right? No one knows how we're going to fund any of that, but everyone says that we have to figure out, we have to fund it, got to keep it going. It's just one of many examples of, solutions, problems that we have without solutions.
Yeah, and the pain you're talking about, of course, is no politician is going to be elected, and they know it full well, by saying we need to increase taxes and reduce spending. Right?
Yeah, there you go.
It's not going to happen.
Yeah, exactly. Can you imagine? Go ahead and just running anywhere in the country and say, yeah, I need to raise your taxes. I need to cut your Social Security and Medicare benefits. I need to increase your retirement age, right? You can't retire at, 65 anymore. You got to retire at 72. And on top of that, there's a bunch of other social programs that we have to completely wipe out.
So this is the inevitability of it. Looking at the different, so I've actually been researching this in some detail. And because I think the exact same thing that you do. I personally think that there is an accelerant in the White House, and that the inevitability has come closer than it has been in recent years. But I looked at the Great Depression to see how did the people that went into came out of the Great Depression, what did they do going in, what did they do during, and how did they emerge? And you look at Hilton and various others that just came out incredibly strong, and you fit two things: one, delever; two, long-term debt. The other thing that they talk about is cash reserves, having cash available. Talk to me about cash reserves again in the real estate context and how you're dealing with that.
Yeah, that's a great topic. I'm glad you brought it up. I mentioned in the book, right? We don't have enough savings as a country in general. The savings rate is now at one of the lowest levels it's been in history. So as a population, we're not saving enough and we're not investing. But as a industry as well, you know, having enough cash reserves as a business or an individual is really, really important, even though that cash, is devaluing. Um, and how do you protect that so it doesn't devalue, especially if the crisis, is farther out than it's farther than sooner. But yes, having those cash reserves, I believe, to your point, is going to allow people to have great opportunities when it comes. Right? When you do, as you said, when you look at the Rockefellers of the world, or the Kennedys of the world, or the Guggenheims of the world, right? They made extraordinary amounts of wealth during the crisis because they had cash reserves and they could take advantage of opportunities which were literally cents on the dollar, right? Not 30 cents on the dollar, 2 cents on the dollar.
Mm-hmm.
But you need cash reserves to do that. And so, as a country and as an industry and as individuals, we need to have greater savings.
As a company, how do you assess how much cash reserves that you want? Is it a percentage of AUM? Is it like how do you assess that in terms of cash reserves?
Yeah, I mean, I think if you're in the real estate business, either a percentage of AUM, right, or a percentage of your free cash flow, and then you just sort of commit to a percentage of your free cash flow continues every year to go to reserves, and you keep continuing to build those up. We're especially the public companies, right? Cash reserves are usually penalized, right? Your people want you to either, put those out in the dividend or invest them.
Mm-hmm.
I think that's bad practice. But our quarterly reporting systems and our public markets, trained us to minimize cash reserves.
Mm.
Hopefully, we'll sort of be smarter than that. But as private companies, it's a lot easier for me to increase my cash reserves and maintain them at high levels. I can do that as a private company. It's harder as a public.
Yeah, and actually, you quoted Charlie Munger, and Warren Buffett, of course, are famous for their cash reserves at the moment. Right? What has he got? More than he's ever had before. So I forget. I'm not sure if it's 30 billion or 300 billion. Some massive amount of cash, right? That he's sitting on. What's he thinking, do you think? I mean, here I'm asking you to mind read, but I assume that he's got the same sense of what's going on as you and I do.
No, I actually quote. Yeah, he's a mentor of mine, and I quote him a lot in the book.
Yes.
There's an enormous amount of wisdom and experience. He shares it and freely, but no one really listens. And so when you talk about Buffett, there's a lot that we can learn from him. And yeah, he said, he's pretty clear why he believes, why his cash reserves are at the highest in the history of Berkshire. He quotes a couple of reasons, but one of them is, he just doesn't see the opportunities right now. And he also sees a problem with the debt. And so, PE multiples are the highest they've been, at least as on an average or a mean, right? So, it's expensive out there to buy anything. Hard assets, income producing assets are still expensive. And so he doesn't see a lot of opportunity. He sees risks, and he sees more value in cash than he does in, making an investment.
That has to suggest an anticipation of a buying opportunity sometime in the future. Who knows when exactly? What are you seeing in the real estate world? Are you seeing buying opportunities? Are you looking to buy? Are you looking to divest and go to cash? What's your approach at the moment?
No, we don't see many opportunities. You've got, there's no real sort of positive arbitrage between cap rates and interest rates. And so that's one metric that we look at, and it's not favorable. We also see sort of a lot of pressure on certain asset classes.
Mm-hmm.
And so we don't see a lot of opportunistic purchases. And then we look at about another 10 or 11 different metrics besides the few I just mentioned. And nothing was really pointing to that this is a real buying opportunity.
Is that because others of your peers are, I want to say, use the word suffering from normalcy bias, and therefore thinking short term in their underwriting of deals, not thinking long term in the same way as you do, and therefore bidding prices up? I mean, what's going on? Why is there no opportunity? If everyone thought the way you and I did, what would the world look like, I suppose?
There'll probably be less cash in the. I mean, I don't know if there's an easy answer to that. I mean, I want to simplify it, and I think I don't do it justice by simplifying it. But we've printed a lot of money over the years. That money's worked its way into the system, and it's done its job, which is it's propped up asset prices. And, when you can buy real estate today and you're buying it at the same rate, the cash on cash return at the same rate, or that you're getting the same cash on cash return that's equivalent to the risk-free return, or pretty close. It just, how do you justify that? Right?
Mind-blowing. Yeah.
Yeah. So, I mean, people start, financially engineering by saying, okay, well, that's just the cash and cash. You have to look at future appreciation.
Right.
Right. And then they start looking at, terminal values, or looking at IRR and what kind of value creation or value appreciation is going to be added to the cash on cash return.
Mm-hmm.
That's a hard sell for us. And so we're relatively dormant right now. We are looking for opportunities where we find deep value, but they're very, very hard to find, and it's rare. So our transaction volume's off by probably 90%.
Are there any asset? I mean, are there any asset classes that you are focusing on? And you mentioned that some are particularly struggling, but other than the obvious ones, what's your, where are you pointing the StarPoint ship?
Yeah, so we're looking for unique opportunities where we can find really, really deep value. And what does that mean? That might mean that we've got a motivated seller who's, worked through their first buyer, their second buyer, and now they're on their third buyer, and they need, surety of close. They need confidence in their next buyer, and they're discounting the value deeply because they're a motivated seller who needs a reliable buyer, and we're getting a deep discount because of that. And so, it's what I call sort of, hanging around the hoop for the rebound. So we're pursuing those strategies, looking for deep value and deep discounts, but it takes a lot of work, and few opportunities pop up. in that strategy. But as far as specific like asset classes where we're seeing deep value and great opportunity, nothing aligns.
You talked about the aging, and I know we're coming to the end, so I'm going to wrap up. But
No worries.
so another part of your book, there was a focus on the aging of America. You don't think that medical related or aging related real estate is a good long-term hedge against the chance of a debt crisis, because the aging of America is even more inevitable than a debt crisis?
Yeah, that's really interesting. Yes, smart. That actually takes some real deep thinking to, connect those dots. And I like the thesis and the demographics support exactly what you're saying. What my worry is that the savings rate is so low. And unless that population is going to be able to rely on Medicare and Medi-Cal and Social Security to pay for that care, I don't know where the money's going to come from. And so Social Security and Medicare is bankrupt within 10 years. Our off-balance sheet debts for that are close to almost $90 trillion. We don't have that. I don't know where it's going to come from. That will accelerate the timing of the crisis dramatically if we try to make those two social programs solvent. So, yeah, this is what I call the great conflux, right? Yeah, we've got, for the first time in history, we've got debt levels that we've never seen, an aging population that we've never seen, longevity that we've never seen, and a savings rate at all-time lows. I'm not smart enough to know how all of that converges and resolves. So, yeah, your thesis is great. If they can pay for it, elderly care within real estate is a great business.
Yeah, and so we're going to wrap up now, but I've got some sign-off questions. But actually, just to continue that thesis slightly, the baby boomer generation is the generation that is going to age out over the next, 10, 20, 30 years. They all own homes, right, at 2% that are worth 2.5% or whatever, or even no debt. That's where the money comes from for senior housing, is selling those assets and using the equity that they have locked up to pay for care. That's what I've seen in senior housing. Anyway, when I've been involved in senior housing, that's why I see people getting the money. Their heirs aren't so happy about it, but it's what keeps. It's what keeps them in coffee and bagels in the morning, and good nursing care. All right, listen. So we've not got much time. Let me just ask you a couple of quick sign-off questions, if I may, Paul. Okay, so what are the key market signals that you are watching that will give you early warning signs of an impending debt crisis?
Yeah, that's a really good question. So, and this is not my thinking. I'm sharing the thinking of others who I would consider smarter and in this space. So, a gradual increase in our interest rates. Right? The public markets and the world markets starting to send the signal that we see the same risk and we expect a higher return to buy our bonds.
Yeah.
A decoupling of the flow of funds. What does that mean is usually when you see a flight to safety, people will move into our bonds and our bond rates will come down. So when people move money out of equities or stocks because they're looking for safety and they move it into our bonds, right? When we see that, so you'll see equities come down and bond prices go up or interest rates come down. When that decouples, when we see equities drop and interest rates go up,
right,
that's going to be another indicator of a problem.
yeah.
If you listen to Reinhardt and Rogoff, you know, they say, you know, it happens fast, and you know, it's like a cliff. They have a terminology for it, and sitting here, I can't remember it, but it's like a bang moment, as they refer to it. And they say usually it's not gradual, that loss of confidence. There's that bang moment, and it happens very, very quickly. And so there's not a lot of warning signs.
Yeah, it's like this idea of going bankrupt. Somebody was asked, I can't remember who it was. They said, "Yeah, how did you go bankrupt?" He said, "Very slowly, and then all of a sudden."
Yeah, yeah.
Happens really slowly, and then
bang.
Yeah, and it's over. Right, another question. So I wasn't quite sure how to phrase this one. I want to phrase it the way that I wrote it. I've written it a few dozen different ways, but here it goes. If you were starting over today with $1 million and no network, what would you do with that money over the next 12 months?
Sorry, the question was if I had $1 million of net worth and no money?
So the idea was if somebody had $1 million today in cash, what would you be advising? So I didn't want to ask you to give advice, investing advice, but if you had $1 million of cash, what would you be thinking about doing with that over the next 12 months? And that's all you have, apart from, you're covering your expenses, etc. A bonus million.
I'm going to give the simple answer because I don't have a real thoughtful one, and I would say I'd well diversify the capital, especially if it's only over the next 12. I'd diversify that capital over 9 or 10 different asset classes, and make sure that you just protect it.
You wouldn't hold it in cash?
Some of it, probably only about 15 to 20% cash.
Really? And the rest in different real estate asset classes?
Because if I only had $1 million and I need obviously some type of income to support myself with that $1 million, that's part of my
extra million. An extra million. You're not going
to... it's an extra million. I don't need the income.
Yeah.
No, I'd probably almost hold it all in cash. 80% in cash, 20%
in 20% in what?
Invested.
Okay. Right, I tell you what, I did have 3 questions. Let's wrap it up there because we're right at the button here. I do want to make one point before I say thank you for joining me. You have repeatedly referenced people smarter than you throughout this conversation. Paul, that must be a very small number of people. I think you're one of the brightest professionals in the industry. I really do. Sincerely mean that. Paul Daneshrad, pronounce your name correct, right? Yeah. Paul Daneshrad, founder and CEO of StarPoint Properties. Thank you so much for joining me.
Thanks, Adam. I appreciate you having me on. It was a pleasure.
All right, that was Paul Daneshrad, founder and CEO of StarPoint Properties. Paul, boom, thank you so much for joining me today. You spent a good bit of time, more than I know you had scheduled for, with me today, so I'm really appreciative of that. And I have enormous respect for your point of view and for the strategies and approach that you are taking to commercial real estate. You are going to be, if you are not already, one of the great winners in this industry in the coming months and years. So thank you so much for joining me. And thank you to dear viewers and listeners. Go to GowerCrowd.com, click on the podcast link at the top of the page, find the podcast with Paul Daneshrad and click on the link to his website, get to know him. He is a very bright fellow who knows exactly what he's doing. Sign up for his newsletter as well. Can't believe I'm even saying that. Before I say go to GowerCrowd.com and sign up for my newsletter, of course. But you want to stay close to the StarPoint basket for sure. He has the right exact perspective on what's going on in the market, how to protect yourself and how to thrive as well in this market. Okay, that is all I have for this episode. Thank you so much for joining me. Until next time, it's Adam Gower signing off.